Welcome to the deep dive. Today, we're looking at, a really strong consensus coming from some big names in financial analysis: Mizuho, TD Cowen, Benchmark, all looking at strategy, MSTR, the company that's really built its whole identity around Bitcoin. And the thing we're really trying to get our heads around today is this. The latest quarterly reports, they looked a bit cool, like Bitcoin buying slowed down, and that premium MSTR usually trades at, it tightened up. But despite all that softness, the analysts are, pretty much all shouting buy. So our mission today is to unpack why. What's the specific thing they're seeing, the catalyst that makes them expect this massive reacceleration for MSTR by 2026? We want to find that blueprint.
All right, that's the fascinating part, isn't it? This sort of disconnect between the short-term picture and the long-term conviction. You have to remember, MSTR deliberately rebranded. They're not just, a software company holding some Bitcoin anymore. They position themselves as a Bitcoin yield company. It's basically about capital structure innovation. They take investor money, turn it into Bitcoin, yes, but then they use financial engineering, leverage their corporate status to try and get better returns than just holding spot BTC. And they are still the biggest corporate holder, right? Sitting on, what was it, 640,808 BTC. That's huge, like 3.1% of all Bitcoin. The analysts seem to think that basic engine is sound, even if one quarter looks slow.
Okay, let's unpack that short-term picture then, because that's where the questions are coming from. Q3 report showed the slowdown. Fine. But you mentioned the premium tightening. That seemed like a clearer signal that maybe the market's less excited. Analysts call it the mNAV multiple. For listeners maybe not buried in finance reports all day, what is that mNAV multiple again? How does it work?
Sure. It's basically a measure of how much more investors are willing to pay for one share of MSTR compared to the actual value of the Bitcoin that share represents.
Yeah.
And yeah, that premium, it recently dropped to 1.2x. Now, historically, MSTR has often traded way higher, sometimes over 1.5x, so 1.2x. That's the lowest we've seen since like early 2023. Normally, yeah, you might see investors get nervous there, thinking the extra cost isn't justified.
So why aren't they panicking? If that financial engineering premium is shrinking, why did the stock actually climb about 5% to around $270 when Bitcoin was just kind of sitting there around $109,500?
Because, well, the consensus view across these firms is that this slowdown is cyclical, not structural. That's the key distinction they're making. They're saying the core model to, convert capital, maintain some premium, it's still intact, the compression. That's more about the current environment. Tighter credit, maybe lower Bitcoin volatility for a bit, just general market cooling. The way MSTR gets that premium, fundamentally, is by being able to tap capital markets quickly, often issuing new shares and just plowing that money straight into Bitcoin. They use their corporate setup to do things a simple spot ETF can't. Analysts believe that mechanism's ready to go again. It just needs slightly better conditions.
Right, which leads us to these really bullish forecasts. Let's start with Mizuho Securities. They kept their outperform rating, okay, but the price target, $586, that's ambitious. What's underpinning that? It seems like they're really focused on the yield MSTR generates on its Bitcoin treasury. They said the model hit 26% year to date, which is pretty close to their 30% target. So the idea is, as long as MSTR can keep accessing capital and selling shares at a premium, they can keep boosting the Bitcoin per share number.
Exactly. And that whole compounding idea really hinges on a big jump in Bitcoin's price itself. Mizuho's model assumes Bitcoin hitting, get this, $150,000 by the end of 2025. I mean, that's not just optimistic. That implies pretty significant growth, like 20–25% year on year for the next couple of years. They point to that 26% yield performance as kind of proof the model works when prices are rising. They basically said higher Bitcoin prices plus capital access equals positive yield and multiple expansion.
Okay, but wait a second. Isn't that $150,000 Bitcoin price kind of doing all the heavy lifting there? What if Bitcoin only gets to, say, $120,000 by late 2025? Does the whole thing stall? Or is the model stronger than that?
That's a really good question. I mean, yes, the analysts definitely acknowledge lower BTC prices would mean lower yield, obviously. But the key for someone like Benchmark is the capital structure itself. Benchmark actually has the highest target, $705. And they see this current premium compression, that 1.2x number, as a buying opportunity, precisely because they think the structural advantages are still there, regardless of short-term Bitcoin wobbles. Mark Palmer over at Benchmark argues it's temporary. Just, the Bitcoin market getting a bit more mature, maybe less volatile overall, doesn't mean the MSTR approach is broken. The underlying asset, Bitcoin, isn't going anywhere. And MSTR keeps finding ways for investors to get exposure.
And Benchmark specifically mentions strong demand for one of MSTR's tools, this perpetual preferred stock program. What exactly is that, and why is demand for it so important for MSTR?
Okay, so think of perpetual preferred stock, like a sort of hybrid. Pays a steady dividend, kind of like a bond, but technically it's equity. And crucially, it never matures, it's perpetual. And MSTR links the dividend payout to its Bitcoin performance. So demand for this stuff is key because it lets MSTR raise money without diluting the common stockholders quite as much. It feeds the machine. Plus, it gives certain investors this tax-advantaged way to get yield linked to Bitcoin. It's a pretty neat niche product.
Got it. So the takeaway from Benchmark is basically, don't panic about the premium shrinking. It's an opportunity. The structure's sound, just waiting for better macro vibes and maybe more institutional players.
Okay, this is where it gets really interesting, I think, because we need that specific catalyst, right? Something concrete that explains why all these analysts see a big reacceleration coming in 2026. Not just things getting back to normal, but like a step change. And TD Cowen seems to have pinpointed it. Exactly, TD Cowen. Now, they did trim their target a bit to $535, acknowledging the short-term cooldown,
Yeah.
but they kept the buy rating. And yeah, they found the game changer. It sounds boring, but it's MSTR's new B-S&P credit rating.
Okay, hold on. A credit rating. That doesn't usually scream massive growth catalyst. But Cowen puts a huge number on it. They suggest this B- rating could unlock $4.9 trillion in new institutional funding capacity. Help me connect those dots. How does a B- rating suddenly open the door to almost $5 trillion?
It's all about the rules these big institutions play by. Think pension funds, huge endowments, sovereign wealth funds. Many of them have strict rules, fiduciary duties. They can often only invest in securities or instruments that have a recognized credit rating from agencies like S&P or Moody's. Before this rating, MSTR's debt, or similar offerings they might issue, was basically unrated, so it was off limits to this giant pool of capital. Now, with a B- rating, it's not investment grade, sure, but it's a rating MSTR can potentially issue credit instruments that these massive funds can buy. We're talking about maybe tripling the addressable capital pool over time. It's like building a new highway entrance for institutional money. It makes them investable to a whole new crowd.
Wow, okay. That is potentially huge. Changes their funding game entirely. But it wasn't just the rating, was it? Cowen also highlighted another angle MSTR is working, something about tax treatment, return of capital.
Yes. This is the kind of financial engineering magic part, ROSI, or return of capital treatment. On those preferred stock dividends we talked about, what ROSI means essentially is that when an investor gets a dividend, it's initially treated as if MSTR is just returning part of the investor's original capital, not as taxable income. Now, this lowers the investor's cost basis over time, sure, but the killer feature, it provides indefinite tax deferral on that income. For big institutions, long-term holders, that's incredibly attractive. You get the yield, potentially linked to Bitcoin's upside, but you don't pay tax on it until you finally sell the shares, which could be years or even decades later. So you combine potentially accessing that $4.9 trillion pool with offering them a structure that defers taxes indefinitely. Well, that's the engine analysts see driving that big 2026 reacceleration.
It makes it such a powerful package that TD Cowen actually said, and this is pretty bold, Bitcoin maximalists should prefer owning strategy over spot ETFs. That says a lot about how effective they think this corporate wrapper is. Okay, so let's try and wrap this up for the listener. What does it all mean for you? Let's recap the sort of three main drivers analysts are pointing to for this big return to growth, probably by early 2026. First, obviously, they need Bitcoin's price to keep climbing, heading towards that $150K kind of target. Second, this huge expansion in institutional access thanks to the new credit rating, that $4.9 trillion potential. And third, these clever tax advantage structures, like the ROSC preferred stock, that are designed to pull in exactly those big, patient institutional buyers MSTR wants.
Yeah, and connecting it back, MSTR isn't just a passive Bitcoin holder like an ETF. It's trying to add something extra yield, leverage through smart capital structure moves. Using its corporate status for advantages a simple fund just doesn't have. So the current slowdown, analysts are framing it as just, tougher macro conditions for a bit, not a sign the core idea has failed. They see MSTR as maybe the most leveraged corporate play on Bitcoin out there, and crucially, as a long-term yield engine, not just a quick speculative bet.
It's definitely a complex picture. And hey, if you found this deep dive useful, sort of seeing how these major firms are looking past the current dip to project this big structural shift, please remember that subscribing, commenting, liking, it really does help us out. Supports the channel, helps us show up in the algorithm, and basically lets us keep making this kind of crypto and finance content for you. So the bottom line from the analysts seems surprisingly clear. This near-term cooling. It's just setting the stage for a much bigger fire, expected to really ignite by 2026.
Which does leave us with a pretty interesting question to chew on, doesn't it? Thinking about that TD Cowen take and these new institutional doors MSTR has unlocked, With this credit access and these tax advantages, could the MSTR model actually start pulling serious institutional money away from just buying spot Bitcoin directly? And what might that mean for how the whole crypto market is structured long term, especially as we head into whatever happens after the next Bitcoin halving in 2024, 2025? Definitely something to think about.